Parks Capital, where education plus investing equals success.
Hi, I'm Meg Prokop, your service associate here at Parks Capital. On the 1st of February, Fed Chair Jerome Powell announced that the Federal Reserve would be raising interest rates by 0.25 percentage point, the smallest rate increase since March of 2022. While the market rejoiced at the suggestion of inflation beginning to calm down, Powell made it clear that in his eyes, the risk of not fighting inflation enough was more dangerous than fighting too hard and causing a recession. Even with the good news about inflation, over 60% of economists are still predicting there will be a 2023 recession, a part of the business cycle that everyone dreads. Yes, recessions are painful and are equated with increased unemployment, tighter budgets, and just the general disruption of everyday life. We are all extremely well versed in the horrors of recessions. So today, I will be making an argument for the opposite: why recessions are great. Okay, great might be a bit of an overstatement, but recessions are a necessary part of the business cycle. The business cycle is a pattern in the economy that it continuously repeats itself. There are 4 stages to the business cycle: expansion, peak, contraction, and trough. When the economy is in the expansion stage, the economy is growing. Productivity is on the rise, gross domestic product is experiencing healthy growth, and prices in the market are rising, making both businesses and investors happy. The peak stage of the business cycle is when all of that growth begins to level off. The economy has reached its fill, and GDP stops growing as quickly as it was during the expansion stage. Inevitably, after the peak stage, the economy begins to contract, more commonly known as a recession. During economic contraction, GDP begins to shrink and often leads to higher unemployment and lower prices throughout the market. Recessions are most often characterized by 2 successive quarters of declining GDP, but it's not a hard and fast rule. The 4th stage of the business cycle is the trough. This is when the rate of GDP decline begins to slow down and eventually transitions back to the expansion stage, beginning the cycle all over again. Although frustrating and painful, recessions play a vital role in the health of our economy. Continuous growth in GDP cannot be healthfully sustained without the occasional reset. When the economy is booming, investors, consumers, and businesses are excited about any and all prospects for the future. This is when bubbles are created in the economy. Speculative bubbles are when investors overvalue a commodity or asset. Its rising price is a result of investors not wanting to miss out on what seems to be a great opportunity. Intrinsic or true values of assets can be very difficult to determine, and this murkiness convinces investors that maybe things like Beanie Babies really are worth more than we originally thought. One of the earliest and most famous instances of a speculative bubble was the Dutch tulip bubble of the 1630s. With their rise in popularity, tulip prices skyrocketed, with single bulbs costing nearly as much as houses did in early 1637. Unsurprisingly, consumers began to realize they may be overvaluing tulips, which led to the bubble being burst and the price of tulips plummeting by 99% in May of 1637. When the economy is growing very quickly, it's easy for assets like Beanie Babies and tulips to be overvalued because investors are excited. During the expansion stage, every idea sounds like a great idea. The economy gets overheated at this point, and the market struggles to effectively evaluate what things are truly worth. If GDP were to have unchecked growth, valuing assets, commodities, or new inventions would be nearly impossible. A recession is a reset for the economy, allowing it to slow down and reassess the valuations it's made. The main way in which a recession helps the economy is by trimming the fat from the market and strengthening its foundations for future growth. When recessions occur, investors direct their money towards companies and commodities they believe in and start to pull away from those they think might be at risk. Unfortunately, this often means that companies go out of business, but taking those weaker links out of the market makes its foundation stronger in the long run. Not only does the foundation become stronger, but gaps in the market that were previously in the shadows of those weaker businesses become exposed, and this creates opportunities for innovation and better efficiency. Take the Great Recession of 2008-2009, for example. Households across the nation were struggling as unemployment rose, and their budgets for luxuries like going on vacations or taking a taxi instead of public transit were much smaller than they had previously been. Two companies founded in the thick of the Great Recession saw opportunities in those smaller budgets and higher unemployment, and they very successfully capitalized on them. Airbnb and Uber. Airbnb, founded in 2008, saw individuals with multiple homes unwilling to sell them in such a downturn market and offered them an opportunity to gain a second stream of income. They also saw consumers with tighter travel budgets and offered them a cheaper alternative to hotels. Uber did the same thing in 2009, giving flexible and achievable employment opportunities to the rising number of unemployed people, as well as cheaper and more reliable transportation for consumers. Recessions bring necessary restructuring and give the market opportunities for innovation with staying power, fostering future growth down the road. In general, downturn markets do not benefit most investors. However, there are silver linings. Interest rates often rise in the early days of a recession, and while higher interest rates make borrowing more expensive, they also have some positive effects, like raising returns on savings accounts, boosting interest income for retirees, and increasing the yields on bonds. Because recessions often cause market prices to lower, they give investors an opportunity to lower their average cost paid for their assets, making it easier to break even and gain when the market recovers. Furthermore, downturn markets sharpen your instincts on what's worth investing in and what is not, better preparing you for the next contraction in the business cycle. Recessions are filled with uncertainty and difficulty, but they are necessary and unavoidable, so it's worth coming into them thinking about the positives as well as the negatives. A 2023 recession is not guaranteed, but a recession sometime in the future is. Whenever that stage of the business cycle arrives, we at Parks Capital will be here to help you avoid some of those market losses and help you take advantage of the opportunities that come out of the recession. Recessions may be disruptive and painful in the short run, but in the long run, they foster innovation, increase efficiency, and provide the foundation for a stronger and more dynamic economy. If you have any questions about this, please don't hesitate to ask us. We're happy to help. Parks Capital is built on a single mission of helping our clients achieve their long-term financial goals. We know that education plus investing equals success.
Here at Parks Capital, we strongly believe that a successful investor is an educated investor. For this purpose, we've created our own YouTube channel. Education plus investing equals success.